Welcome to our financial management course. In today's lesson, we are going to talk about one of the most common investments people hear about, stocks. You may hear phrases like, the stock market went up today, or someone invested in a company's stock. But what does that really mean? What exactly is a stock? What happens after someone buys one? And what should investors realistically expect, both the rewards and the risks? Instead of approaching this like a theoretical lecture, I want to walk through a simple story that reflects how people actually experience investing. By the end of this lesson, you should have a clear and intuitive understanding of what it means to invest in a stock. Imagine two friends sitting in a coffee shop. One of them, Maya, has a business idea. She wants to start a small company that makes and sells healthy energy bars. She believes people will love the product, but there is a problem. Starting a business requires money for ingredients, packaging, marketing, and production. Maya cannot afford all of these costs alone. So she asks friends, family, and other investors if they would like to contribute money to help the company grow. In exchange, she offers them ownership in the business. That ownership is represented by something called a stock. A stock is simply a small piece of ownership in a company. When someone buys a stock, they are buying a share of that company's future. If Maya divides her company into 1,000 shares and you buy 10 shares, you now own a tiny portion of the business. You are not running the company, and you may not be making day-to-day decisions. But you do have a financial stake in how the company performs. If the business grows and becomes more valuable, your shares may also become more valuable. So when investors buy stocks, they are essentially becoming partial owners of businesses. Now imagine that you decide to invest in a company's stock. You open an investment account and purchase shares. Once the purchase is complete, you officially own those shares. From that moment on, two important things can happen. First, the price of the stock may change over time as investors buy and sell shares in the market. Second, the company might distribute a portion of its profits to shareholders through something called dividends. So after buying a stock, you are essentially watching how the company performs and how the market values that company. When people invest in stocks, they usually hope for two main types of rewards. The first is price appreciation. If the company grows, becomes more profitable, or develops successful products, investors may become more willing to buy the stock. This increased demand can push the stock price higher. If you purchased the stock at a lower price and later sell it at a higher price, you earn a capital gain. The second possible reward is dividends. Some companies share a portion of their profits directly with shareholders. In that case, investors receive periodic payments simply for owning the stock. Of course, investing in stocks does not guarantee success. Just as companies can grow and succeed, they can also struggle. Maybe Maya's energy bar business becomes very popular. Or maybe consumers lose interest and sales decline. If a company performs poorly, investors may become less willing to buy its stock. The price could fall. If you sell the stock for less than what you paid, that loss becomes your financial loss. So when investors buy stocks, they must accept uncertainty. This balance between risk and reward is one of the central ideas in finance. Stocks historically have the potential to generate higher long-term returns compared with many other investments. But those higher potential rewards come with greater uncertainty. Prices can rise quickly, but they can also fall. Successful investors understand this trade-off. Instead of expecting guaranteed profits, they focus on long-term growth, diversification, and patience. Over time, investing in strong companies can help build wealth, but it requires discipline and an understanding of risk. So the key idea to remember is this: a stock represents ownership in a company. When investors buy stocks, they are participating in the success and the risks of that business. Stock investors may benefit from rising share prices or dividend payments, but they must also accept the possibility that prices can fall. Understanding both the opportunities and the risks is essential for making informed investment decisions. Thank you for watching, and I will see you in the next lesson.